Okay, hi, my name is Sana Babar. This is my DuPont analysis project and report. My company is DuPont de Nemours Incorporated, and its competitor company is, I picked its competitor company as Dow Incorporated. So let's begin. So in the abstract, this report, we will assess the financial performance of DuPont de Nemours Incorporated, a well-known traded company using the DuPont chart analysis. We will also carry out a time series and cross-sectional analysis with its competitor company, Dow Incorporated, by using the 5 elements of the financial ratios. The first one is liquidity, efficiency, leverage, profitability, and market value. This report will be used to show how well DuPont de Nemours Incorporated stands up against its competitor, Dow Incorporated, as we measure the various ratios listed above and compare and contrast them to see how the company is doing overall for the past 5 years. So before we begin our analysis, we will start by collecting various financial statements from both companies, DuPont de Nemours and Dow. From the collection of these statements, we will also use the income statements, balance sheets, statement of retained earnings, and also statement of cash flows to determine the ratios in which I will present today. So the introduction, a little bit more about DuPont de Nemours, is that it is a world-class multi-industry specialty solutions company with a large global business aligned with growing, attractive end markets. With over 200 years in business, DuPont de Nemours only just recently became a publicly traded company and was even merged with its competitor, Dow Incorporated, until it was ultimately split. With over $21.5 billion in revenue just in 2019 alone, DuPont de Nemours is a huge company, but we're trying to see if the company is doing well overall compared to its competitor company, Dow Incorporated. Now, a little bit about Dow Incorporated is that Dow Incorporated is also a company, just like the DuPont de Nemours, but it is an American commodity chemical company, which was merged with DuPont de Nemours. The company was later separated from DuPont de Nemours Incorporated in April 2019. Dow Incorporated is also a publicly traded company as well as its competitor company, which is DuPont de Nemours. In this report, we will compare the two companies with each other to see how well the company DuPont de Nemours is doing in the long run with its competitor company, Dow Incorporated. The ratio analysis. The time series from the last 5 years for the company DuPont de Nemours Incorporated will be analyzed, and a cross-sectional analysis will be performed for the company DuPont de Nemours Incorporated and its competitor Dow Incorporated. So we will see all of the 5 ratios. So this is the first ratio, the current ratio and the quick ratio, and you see the numbers from 2015 to 2019, 2019 being the most recent. And then we'll see the efficient ratios, which is the accounts receivable turnover, average collection period, inventory turnover, average age of inventory, inventory to net capital, working capital, total asset turnover, fixed asset turnover, fixed charge coverage. So we will be looking at, these are the numbers from 2015 to the most recent 2019 for both Dow and DuPont. The reason why it'll have like an error sign is because it's just new. It's just newly. The companies are just new, so it doesn't have it doesn't have the given from 2015. Here are the leverage ratios. So we're looking at the basic earning power, debt ratio, debt to equity, long-term debt to equity, and also time interest earned from 2015 to 2019, as well as the profitability ratios, total profit margin, operating profit margin, net profit margin, return on investment, return on asset, return on equity, and also the market value ratios. So the price earnings, the market value to book value, the cash flow per share, dividend payout, dividend yield ratios from 2015 to 2019. All right, so the liquidity ratio. So in the liquidity ratio, a company's ability to pay off its debts, mainly its current liabilities, is most commonly known as the liquidity-based ratios. The liquidity ratios we have analyzed between DuPont and also the Dow Incorporated is the current ratio and also the quick ratio. When we're measuring the current ratio, we're looking for the company with a result that is more than 1. If a company has a result that is less than 1, then that means that the company does not have enough money within their assets to pay off their current liabilities. And that is if the company were to go bankrupt. When we measure DuPont and Moore's and Dow, the current ratios from 2019 to basically 2015 to 2019, we can see that since both companies didn't have enough information to cover all 5 years, they both only recently, because they did not have enough information, due to the fact that they only recently became public, they did not have enough information, we can still compare the information we have in the years provided. We can see that both of the companies have a ratio over 1, which means if both of the companies were to go bankrupt, they would have enough current assets to pay off their current debt. DuPont did have a big drop in 2019 compared to 2018 due to there being an increase in debt put on by the company from year to year, which means as of right now, Dow is doing slightly better. When measuring for the quick ratio, we are looking for the company with a higher ratio, as a higher growing ratio shows that a company is able to use its assets that are most liquid in order to pay off its current liabilities. When we measure DuPont and Dow, quick ratios from 2015 to 2019, we can see from the information we have that DuPont has a huge drop when it came to the ratio between 2018 to 2019. This huge drop is likely due to the company buying more of the inventory while they're increasing their current liabilities. That is clear that the competitor Dow Incorporated is doing better in the quick ratio department from 2018 to 2019. Now, efficiency ratio. A company's ability to use assets and efficiently manage its liabilities in a given period to allow a company to create more revenue for the company is known as efficiency ratio. The efficiency ratio we have analyzed between DuPont and Dow are accounts receivable turnover, average collection period, inventory turnover, average age of inventory, inventory to net working capital, fixed asset turnover, and fixed charge coverage. So we are going to look at all of those. When we are measuring the accounts receivables, turnover ratio, we are looking for the company with a higher turnover rate, as it shows that the company is able to efficiently collect on its receivables. It is also shows that the company's customers are able to pay off their debt on time. When we measure DuPont and Dow, the accounts receivable turnover ratio from 2015 to 2019, we can see from the information that we do have that DuPont has a small decline in the ratio from 2018 to 2019. Same can be said for its competitors, Dow Incorporated, as over the past 3 years that the company has a major downward spike going from 2018 to 2019. When calculating this specific ratio, we can also use it to determine the average amount of days it takes for these companies to collect its receivable, which is known as the average collection period. When looking at the average collection period for both DuPont and Dow, we can see that DuPont currently collects its receivables at a faster rate than Dow. When measuring inventory turnover ratio, we are looking for the company who has a higher turnover rate, as it shows that the company is able to efficiently turn its inventory into sales. When we measure DuPont and Dow, the inventory ratio turnover from 2015 to 2019, we see that the information we have that DuPont has had a decline from year to year, even though Dow has a major decline in the past year, the company is still doing better overall. This can also be shown by the average age of inventory for both DuPont and Dow, as it shows that the average amount of days inventory sits within the company. Another ratio we look at when analyzing inventory is the inventory to net working capital, which shows us how much exactly working capital is financed from inventory. When it comes to this specific ratio, the closer it is to 1, the better. When it comes to the DuPont Incorporated and Dow Incorporated, for the inventory to working capital from the year 2015 to 2019, we see that DuPont has been consistent in that area compared to its competitor Dow. When measuring for the total asset turnover and fixed asset turnover, we are looking for the higher ratio, as it shows that the company is able to use its asset to generate revenues. When we measure DuPont and Dow, total asset ratio and fixed asset ratio from 2015 to 2019, we see that DuPont's competitor is doing better overall in both of those ratios that is shown. As for the last ratio, we will analyze the efficiency ratios, in which we will measure the fixed charge coverage. When measuring the fixed charge coverage ratio, the higher the better, as it shows us how stable a company is when comparing its revenue and its payment obligations. When we measure DuPont and Moore's and Dow, the fixed charge coverage, we can see that both companies in 2019 ended up going negative, with Dow dropping from a high point between the years 2018 to 2019. While both companies are lacking in the ratio, DuPont is still doing better than Dow. Now for the leverage ratio, a company's ability to meet its financial obligations when it comes to its overall company debt is referred to as leverage ratios. The leverage ratios we have analyzed between DuPont and Dow are basic earning power, debt ratio, debt to equity ratio, long-term debt to equity, and times earned interest. When measuring for the basic earning power, we are looking for a higher ratio, as this shows us how well the company is able to generate the earnings from the operations of the company. When we measure DuPont and Dow, the basic earning power, we can see that uh, we can see that DuPont and Dow has a major downward spike in the most recent year, with both dropping to -2%. Although Dow has been doing slightly better over the years, both companies are not performing well for this specific ratio. When measuring for the debt to equity, and long-run debt to equity ratios, we are looking for a lower ratio in all three categories. This shows us how much debt the company has compared to its assets, and if the company is getting most of its financing from loans or equity. When we measure DuPont Nemours Incorporated debt ratio, debt to equity, and long-term debt to equity to Dow, Dow's debt ratio, debt to equity, and long-term debt to equity, we can see that DuPont beats out its competitor in every category besides the debt ratio, in which both companies are still barely close. This shows us that DuPont takes in less debt compared to its equity via its shareholders than its competitor, Dow Incorporated. When measuring for the times earned interest, we are looking for a higher ratio, as a higher ratio shows us how well a company would be able to make payments towards the interest expenses. When we measure DuPont and Dow times earned interest, we can see that DuPont has had a massive drop in their times earned interest just in 1 year alone, while its competitor Dow has always remained relatively low in terms of this ratio. Even though DuPont did have a major downward spike, the company is still doing massively better than Dow. Profitability ratio. A company's ability to measure how well it is performing every year, as well as it gives the shareholders a solid look into this, is known as the profitability ratios. The profitability ratios we have analyzed that between DuPont and Dow are total profit margin, operating profit margin, and net profit margin, ROI, ROA, and ROE. When measuring for the total profit margin, operating profit margin, net profit margin, we generally look for a higher ratio for all three ratios, as it shows us how well companies' profit margins are in total, net, and within the company's operations. When we measure DuPont's profit margin, operating profit margin, and net profit margin to Dow's, we see that total profit margin DuPont has been consistently increases yearly, while Dow has the opposite effect. For the operating profit margin, we see that DuPont has been winning compared to Dow until 2019, in which Dow has a huge upturn. Lastly, we look at the net profit margin where we see that DuPont has been consistently producing better numbers than Dow. Even though DuPont did have a massive downturn in 2019, it still does not compare to the massive drop that Dow had going on, down to -3%. And when measuring for ROI, ROA, and ROE, we are generally looking for the higher ratios, as it shows how much investors and shareholders would make back from the company, as well as how much the company increases a profit from its assets. When we measure DuPont and Nemours and and Dow, in ROA, ROE, and ROI, we see that DuPont has been trailing to its competitor up until 2019, when we see Dow has a huge downward spike. When it comes to the ROA for DuPont Incorporated, we can see that the same thing here, where Dow Incorporated was leading up until 2019 when they had a massive downturn hitting the negatives. Lastly, when it comes to the ROE, we can see the same thing here where Dow was up until 2019, where it ultimately hit the negatives. Now, let's talk about the market value ratios in both of these companies. A company's ability to evaluate the current share price of its stock is known as market value ratios. The market value ratios we have analyzed between DuPont and Dow are price earnings, market value to book value, cash flow per share, dividend payout, and dividend yield. When measuring for price earnings, we are looking for the higher ratio. That means that the investors are more confident in investing in the company. We measure DuPont's and Dow's price earnings. We see that DuPont is clearly leading as in 2019, which had a huge jump, while Dow had been declining, which had been hitting the negatives. When measuring for market value to book value, we are looking for a higher ratio, as it shows us that the current stock price is trading less expensive, which attracts more potential investors. When we measure DuPont and Dow market value to book value, we can see that DuPont is only just behind its competitor in the most recent years. When measuring for cash flow per share, we are looking for a higher ratio, as this means that the company would possibly produce higher earnings per share, which again attracts investors. When we measure DuPont and Dow cash flow per share, we can see that its competitor clearly beats out DuPont in the most current year. Now, looking at the cost of capital, the cost of capital is the expected return to the equity owners and to debt holders. So WACC tells us the return that both stakeholders can expect. WACC represents the investor's opportunity cost of taking on the risk of putting money into a company. Now, when we're looking at the WACC for DuPont, we see that the average return investors and stakeholder is 8.72%. Depending on the investor, this shows that an investor will make a decent sized return on their investments and would likely invest within DuPont. In conclusion, in this report, we have assessed the financial performance of DuPont Dinamores as a well-known traded company by using the DuPont chart analysis. We carried out a time series and cross-sectional analysis with its competitor company Dow Incorporated by using the 5 elements of the financial ratios: liquidity, efficiency, leverage, profitability, and market value. The report shows us that DuPont Dinamores has been doing fairly better than Dow Incorporated in many of these ratios. So therefore, that concludes the presentation.